All right, let's talk about one of the most important and maybe most confusing terms in real estate, the cap rate. You can kind of think of it like a speedometer for an investment property. It gives you a quick snapshot of how fast it's earning money relative to its price. So let's get right into it.
You've probably been there, right? You're scrolling through Zillow or some other listing site, you see a property, and right there in the details it says cap rate 6.8%. And you just kind of nod and think, okay, that sounds good. Well, if you've ever wondered what that number actually means, you're in exactly the right place.
And trust me, you want to understand this, because this one little number is your first big clue to figuring out if a deal is great or one you should run away from. So let's cut through the jargon and start with a super simple definition. Okay, so the official name is capitalization rate. It's basically a way to measure the potential return on an investment based only on the income it's expected to bring in. But honestly, let's forget the textbook definition. Let's get to what really matters. It all comes down to this simple little formula right here. This is it. This is the engine. It's the net operating income, or NOI, divided by how much the property costs. We're going to break down every single part of this, so don't worry. To make this super clear, let's forget about buildings for just a second. Imagine you buy a vending machine for $10,000. Now, after you pay for all the candy bars and the electricity to run it, you're left with a profit of $1,000 for the year. Your return on that 10 grand is 10%. Well, guess what? That's the cap rate. Just swap out vending machine for duplex, and you've got the concept down. So here's the one question that cap rate is built to answer. It's this. If I walked in and bought this property with a suitcase full of cash, no loans, no mortgage, nothing, what percentage return would I get on my money in 1 year? That's it. It's the purest look at how the property itself performs as a business. All right, theory time is over. Let's roll up our sleeves and actually run the numbers on a real-world example. We'll go step by step, you'll see exactly how it's done, and it'll all click into place. So let's say we're looking at a duplex, and the seller is asking for $500,000. That $500,000 number, that's our property value. That's the starting point for our whole calculation. First, we've got to figure out the income. Let's say each side of the duplex rents for $2,000 a month. So that's $4,000 a month in total, times 12 months in a year, and that gives us a gross annual income of $48,000. But, it's not all profit. You've got to pay to keep the lights on, so we have to subtract all the operating expenses. We're talking property taxes, insurance, maybe some landscaping, repairs, the whole shebang. For our example, let's say all those costs add up to $18,000 for the year. And now for the magic. We take our $48,000 in income, we subtract the $18,000 in expenses, and we are left with $30,000. This number is so important. This is our net operating income, or what you'll hear everyone call the NOI.
Okay, we're at the finish line. We just plug our numbers back into that original formula. We take our NOI, that's $30,000, and we divide it by the price of the property, which was $500,000. And the calculator says 0.06.
And there you have it. You just move the decimal over, and that gives us our cap rate, 6%. It's that simple. If you bought this duplex with cash, you'd be looking at a 6% return on your money each year. Okay, so we figured out our duplex has a 6% cap rate. The natural next question is that good? Is it bad? Should I be excited? And the real answer is, well, it depends, because every cap rate is telling a story about the trade-off between risk and return. So here's how to think about it. Lower cap rates, maybe in that 3 to 5% range, usually mean a safer, more stable property in a really nice area. You're getting less cash in your pocket right now, but you're betting that the property's value is going to go way up over time. On the flip side, higher cap rates, say 7, 8, even 10% plus, mean more cash flow today, but they usually come with more risk. Maybe it's in a rougher neighborhood, or it's an older building that needs a lot of work. It's all about what you're optimizing for. Now, this next part is just as important as knowing how to do the math. You have to be crystal clear on what the cap rate is not telling you, because it has some serious blind spots. Remember how we said it's based on an all-cash purchase? Well, that means the cap rate completely ignores your mortgage. It has no idea what your interest rate is. It also doesn't factor in your down payment, any future appreciation, tax write-offs, or the awesome feeling of paying down your loan. It is a first-glance tool, a filter. It is not the final word on whether an investment is good for you. Okay, you ready for a pro-level move?
Let's talk about how really experienced investors flip this entire idea on its head and use it to find amazing deals. This is a really powerful shift in thinking. So instead of using a property's price to figure out its return, what if you use the return you want to figure out the price you should pay? See, if you know how much income a property makes and you know what cap rates are typical for that neighborhood, you can actually determine what that property should be worth. You just rearrange the formula. Property value equals the NOI divided by the going market cap rate. This isn't just a party trick. This is the primary way that big commercial buildings are valued. Their price is literally determined by the income they spin off. So at the end of the day, a cap rate isn't some magic number that tells you to buy or sell. It's a simple, standardized tool that lets you quickly compare the income of one property to another. But once you really get it, something inside you shifts. You stop just looking at houses, and you start analyzing income-producing assets. You stop guessing, and you really start thinking like an investor.